a retirement plan case study on a family just like yours. How will they do? Find out next, right here on Your Wealth Health. Good morning and welcome to another episode of Your Wealth Health. I'm Erik Brenner, president and founder of Hilltop Wealth Solutions, and I'm really glad you joined us here today. I have Bill Davis here in the studio. We're still practicing social distancing, and Matt Aurenz coming in via Zoom. So thank you to the both of you for joining me today. And I'd like to personally thank Bill for playing host last week when I took a few days off. So we are talking today about a case study. Before we do that, though, I want to thank all of those that are following on Facebook. And you know what? If you know someone that may be of interest to this, please share the link with them. We'd love to have them watch this informative session, as well as if you're watching us on yourwealthhealth.com, thank you for that. So a case study. Have you really looked at your retirement plan? How much do you need to save? Are you on track? Certainly in this global pandemic time, many people may not be on track right now. Secondly, have you thought about how your money's going to be taxed if you are on track? How to take the money? And so we're going to talk about all of that. We've put together a case study, an example of many of the clients that we work with day to day. And so let's dive right in and take a look at the case study. We have John and Mary Smith. They're age 50. They want to retire at age 65, so they got about 15 years. John's current income is $60,000 and Mary's is $40,000. They have a couple kids. One of them is in college and one of them graduated this year. And so they're kind of finishing up the college years and they feel as though they're pretty set on that college goal. Their risk tolerance is moderate. They don't want to take a lot of risk, but yet they want to see some overall growth. And they last revisited their estate planning when their kids were young. So Matt, we have several assumptions within this case that we see a lot of these type of cases every day.
You're right, Erik. I think this is a pretty typical case. People are looking to retire by the age of 65, mortgage getting paid off at age 62. They maybe looking to just spend a typical amount of money, around $60,000 in today's dollars, vacation a year, that type of thing. With the mortgage paid off, they got a little extra money in the pocket. Also looking at just what does adequate healthcare coverage look like in retirement? That's a big one for a lot of people. And I know one of the things that we like to do is carve that out, have that expense separate. So we use a lot of tools and resources to determine what the average cost for healthcare is going to be, understanding Medicare premiums, what those costs are going to be. So we carve that out. And then we just take a look at assumptions. And assumptions in this scenario look pretty common. Social Security for both John and Mary, they're about $23.17 a month for John. Mary, looks like hers is going to be around $17.30 a month. And, it's a pretty common Social Security dollar amount. They also have a Roth IRA that they've been saving in. Last couple of years, balance is around $15,000, and they're putting in about $3,000 a year. And they also have some 401ks at work that they're making contributions to. So pretty typical Midwestern scenario that we see on a regular basis.
One of the things, Matt, I think that's important and people often don't realize is the amount of what their Social Security is projected at. I don't think folks think about having $4,000 or $5,000 a month in Social Security. And you can see in this case, with an average household income of $100,000, that's exactly where they're on track on. So we do have them, a 401k, you mentioned that, in savings. And, Bill, often people, again, don't realize the compounding effect as they're saving money. And, if you tell someone that, hey, you're going to have $500,000, $600,000, $700,000 saved up in that 401k by the time they retire, oftentimes that's hard for them to grasp.
Yeah, this is a pretty common, common approach that someone's putting about 6% of their income in a tax-deferred plan through an employer. The employer's matching, in this case, 50% of it. And if you throw on the Roth money onto $100,000 household income, they're saving about 9%. I think we even underassumed at 9% what most people this couple's age are doing, but we wanted to be realistic in our approach. We also wanted to be realistic in the annual returns. So just utilizing 6% return, 6% of their gross pay going into their 401k, a 3% match over a 15-year period, their retirement plan grows to $500,000. And so hopefully people, middle-class people understand that they can accumulate enough for retirement by the compounding and then the standard approach. And if you were to increase your savings on an annual basis, you could do even better than accumulating the 500,000. So don't think that this isn't possible. You have time on your hands and take a standard approach to you won't miss that money out of your paycheck. And another good strategy is increase your savings as you get an increase in your compensation over the years. So go to 6, go to 7, go to 8. But I think we've looked at a very realistic approach here at 3,000 or about 3% of their income going into their Roth, and about 6% of their income going into their 401ks. And we'll talk later in the show about how much they accumulate in the Roth and how they'll go about distributing that as a tax-free source of income in their retirement.
Yeah, I think you make some good points there, Bill. And you had said that the savings rate in this case, we didn't make them saving an excess amount of money. We get asked often, how much do I need to save? Am I saving enough? And it does depend on the situation. As we've shown here, it's really under 10% as far as a need. Now, we certainly could encourage them to save more. And like you said, if they increase it as they get pay raises, I think that's really important as well. Well, let's talk about, we right now historically are in low tax brackets. And so we get asked often, should I save in a pre-tax 401k or should I save in a Roth? And how do we think about that? I know in this case we have them saving a little bit in Roth money and 401k money. But Matt, how do we kind of direct people along that path?
This is a great question, Eric. I think obviously everybody's situation is a little bit different, but as we take a look at current tax brackets, previous tax brackets, what the current fiscal situation looks like with the government, and where we think that tax brackets are going to go in the future, you kind of have to pay attention to all of it. And I do believe that everything is, just, you got to balance it out. And last week, Bill and I, we were talking about tax control and having the appropriate tax structure for today, at retirement, and upon death. And so you have to equate all of that. And if we look at the graphic, we can kind of see, tax rate comparisons back in 2010 versus 2020. And you can see, the tax brackets, even though we are in a lower tax rate, they are creeping up. And some of that has to do with cost of living and wage increases, that type of thing. But, if you're in the belief that tax brackets will go up in the future, particularly to pay for all the stimulus that right now the government is using to help bail out the economy and businesses, I do believe that, as rates go up, you're going to have to pay attention to how that influences you. So, it's going to be a balancing act of getting in some tax savings today through your pre-tax contributions, and then getting in some post-tax contributions in the Roth. And then in the future, the way oftentimes we look at it is if you believe you're going to be in the same or lower tax bracket in the future, oftentimes you would want to go with more of a pre-tax structure today. If you believe you're going to be in the same or higher tax bracket in the future, traditionally you would want to start looking at Roth type contributions as a larger proportion of your tax savings. But again, some of it has income restrictions, some of it has contribution restrictions. So you have to look at it all But I think at this point, we believe taxes will go up. And so controlling your taxes now to prepare yourself for the future is something that, again, it's in your control. Start taking advantage of it.
Great, thanks, Matt. So we've already looked at here saving. This couple, John and Mary, are they on track for their retirement? We're going to talk about that and more when we come back on Your Wealth Health.
All of our vehicles do come with a warranty. The warranty is nice because whenever you get a vehicle, you're not sure what's going to happen. I mean, it's reasonable to expect that a pre-owned vehicle is going to have an issue, but the warranty is going to help you with any internal engine, internal transmission issues. So those are the big, ugly, nasty repairs, the ones that you need help with, and that's what we're here for. So if you're driving down the road and the transmission just stops pulling, give your sales agent a call, and we'll get the process started to help you get back on the road as quickly as possible.
Welcome back. I'm Erik Brenner, and I'm here and joined by Bill Davis in the studio. We're practicing social distancing, and today we're talking about an actual case. John and Mary Smith, and John and Mary are currently 50 years old, and they are saving for retirement. So we're going to continue to work through that case. If you're watching us on Facebook, if you could hit that share button, we would much appreciate it. And if you're following us or watching us on yourwealthhealth.com, thank you for that. So let's dive a little bit more into this John and Mary case. One of the things we mentioned before the break was the tax brackets. And Matt had mentioned tax brackets relative to 2010 compared to 2020 rates. And I think one of the really important things to think about is we are in the historically low tax rates. And in fact, if we look back in 2010, you got to your 28% bracket at $137,000 in adjusted gross income. And now in 2020, you don't get to 24% until $171,000. So there's really a really big difference there. And Bill, also Social Security and whether Social Security is taxed is and can be a big deal in retirement.
Yeah, and that's going to be a key component of this part of this segment, is looking at how we could get our Social Security and keep it from being taxed. So if you're a single individual, once you have other income sources that exceeds $24,000, your Social Security becomes 50% taxed. And that's just a shame. If you have over $34,000 as a single individual, your Social Security is going to be 85% taxed. And so for a couple married filing jointly, you could have income up to $34,000 for the 50% cut and up to $44,000 for the 85% of Social Security to be taxed. So there's where we're looking at taking advantage of the tax brackets that are lower that you just mentioned, Erik, and then understanding where Social Security taxation begins. So we have this case where we're going to look at the retirement at 65, the accumulation up to 65, and a standard approach that most people would take from as they enter into their retirement plan.
Yeah, thanks, Bill. And it's also important to note on this Social Security taxation, we have to calculate what's called provisional income. So it's not a straight line calculation to determine if Social Security is taxed or not. So let's go ahead and take a look at the graphics on John and Mary. So if you remember, we have John and Mary had a 401k, they were saving money, and we had projected that by saving money with a simplified rate of return of 6%, they would have $500,000 inside the plan. Now, if you look at the $500,000, it's projected to grow to age 72 of just a little over $750,000. Now, we show no distributions out of the IRA. Why? Well, it's because what they plan on doing is they were planning on taking their Roth money that they had accumulated and using that. And this is very common that people, if they don't need the money, they're not going to take it from the source because it's going to be taxed. So they're just going to defer it. Well, then if they continue to defer it, Bill, then what happens is that required distribution comes into play.
So what you see there on the graphic is that the first year required minimum distribution is almost $30,000. So what's happening here is that you're going to start hitting those taxable Social Security numbers more rapidly by deferring the amount, and you're hitting that $34,000 for a married couple by age 75, and then by 85 you're seeing that the accumulation is putting you over the $45,000, and you actually have accumulated $821,000, taking out $55,000 a year is the required, and you can see that the couple has taken out $584,000 out of the account by the time the first person's 85. And then in the last area there by age 89, you can see there's still $765,487, and there's where the Secure Act that we went over last week, that the beneficiaries now have to take out that money over a 10-year time period, the two children.
Yeah, Bill, that really becomes, a true issue as it relates to, over that 10 years and this accumulation of a pot. And we often call it a balloon. It's a balloon that continues to grow over time and it becomes rather large. So we also want to take a look at a software program that we use that is called our tax map. And so if you look on the screen, the way that this lays out real quickly is if you see the red, and you can see between 0 and where the red starts, and there's no red there, okay? And that is basically our personal exemptions and deductions that's given to you. You really don't start paying tax until you get through those personal exemptions and deductions. And so in our base case, we're assuming that they're taking the Social Security and they're taking their Roth money. And so if you look at the green, it actually says tax liability of 0. And their effective rate is 0. And really how we help clients is manage what their effective rate is. Okay? Marginal rates are where your last dollar falls into the bracket. Effective rate is really a key component in tax planning and tax management. So we worked in a scenario and said, okay, we're not paying any taxes in this situation. Sounds good. But remember what Bill said is we continue to accumulate assets in a pot that will be taxed at some point. What if we could take money out at age 65? And even if we don't need it in our cash flow, but still take it out at the same rate. So in this scenario, what we've done is we've taken a look at what if we have withdraw $20,000. So John and Mary, instead of continuing to defer the money, let's look at taking $20,000 out, okay, and do something with it. And we'll talk about what you could do with it here in a moment. But let's do something with it. And you can see, based on our tax software, that still the effective rate is 0. So they've actually been able to draw $20,000 out more in their account, and their effective rate is 0. Well, one option would be to convert it to a Roth. Another option is put it in other investments. But Bill, let's take a look at the slide then, taking the $20,000 out, right? So we take the $20,000 out every year during their age 65 to 72. Now what's the impact?
That's right. So now you can see that we actually are delaying the point in time that Social Security is going to get taxed. That pushed that out another 5 years. We've now got out the same amount of money by age 85, but we have a remaining balance of $626,679. And we've also then reduced the amount of money that's left to the beneficiaries, which will reduce their taxable income at the passing of the second person in this situation. So we've got $20,000 a year out for 7 years tax-free of an account that we never paid tax on, and so there's $140,000 that we were able to get out of the individual retirement accounts at no tax bracket.
And Bill, you know, we talk about this all the time, that 65 to 72, and really it starts at 59.5 to 72, but the 65 to 72 in John and Mary's case is our window of opportunity, isn't it, Bill?
Yes, it is.
And so this window of opportunity, oftentimes people overlook it. And once you get to 72, you're really forced out that money. So, you know, you really don't have a choice then. You're forced the money to come out of the plan. And we talked about the required minimum distributions, which again is forced out. And now, as Bill talked about, you may be paying more taxes on your Social Security and you're locked in. So it's a really good case. It looks like they'll be able to retire, but their tax strategy may need some work. So when we return to Your Wealth Health, what we're going to talk about is what could you do with that extra money that you've taken out? Because remember, in John and Mary's case, they don't need the money. They don't need that extra $20,000, but they can certainly have some tax planning. So we're going to take a look at some options. We're also going to take a look at what that Roth pot's going to grow at, and I think you'll be surprised. So hang in there. We got a lot more to come on Your Wealth Health. Welcome back to Your Wealth Health. I'm Erik Brenner. I'm joined today by Bill Davis, who's in the studio, and he's more than 6 feet away from me, and also Matt Aurenz, who's joining us via Zoom. Hey, we have a very exciting show next week. We have a special guest, Ed Slott. You may have seen Ed on public television. He is a renowned expert on IRA planning and retirement planning, and we are one of Ed Slott's elite advisors. There's more than 300,000 advisors around the country. There's only 400 advisors that actually are in Ed Slott Elite Advisor Program. So make sure you join us next week, and Ed will give us some great insight. You know, during the break, we were talking about some clarity as it relates to IRA and 401k and what we had talked about in the prior segment. And we just want to make sure everyone understands that, you know, whether it's an IRA or 401k, it was pre-tax money. And often people ask, should I move my 401k to an IRA? And it does depend on your situation, but the strategies that we talked about in the prior segment needs flexibility. And you need more than an 800 number. And so there are many reasons to consider why setting up and establishing your own IRA, especially during retirement. So let's talk about that Roth pot, Matt. People are really surprised at how Roth IRA money can grow with compounding over time.
You're right, Erik. Thanks for that. You know, if you take a look at the graphic, this is a beautiful graphic to take a look at. Remember, it's post-tax money going in, it grows tax deferred, and it comes out tax-free once you've hit a 5-year vesting schedule. And you basically take a look at this and you say, hey, I'm assuming the same 6% conservative growth rate. I started at $15,000. I was putting in $3,000 a year up until retirement. And then I began to do this Roth conversion strategy from age 65 to 72. And I'm converting $20,000 a year. And before I know it, I've got over $600,000 in my pot of money. That is 100% tax-free. And oftentimes we'll see people say, hey, I want to buy a car in retirement, but I don't want to take a loan. This is a great opportunity for them to say, no problem. Let's take money out of your retirement Roth account, and it's 100% tax-free. We don't have to worry about that influencing our taxability and provisional income for Social Security. We don't have to worry about that pushing us into a new tax bracket. We don't have to worry about, hey, I need 20,000. I better take out 30,000, pay 10,000 in taxes to net the 20,000. It could be a random vacation, a new roof on the house, whatever that is. You've created that tax control and tax flexibility. The other advantage that we see as people accumulate more money into this pot is upon death. Now when that 10-year spend down comes, their beneficiaries don't have to worry about paying income tax on that distribution like they would have in the 401k or traditional IRA. So just a great opportunity for you to control your taxes and determine where you're going to put your retirement assets.
Yeah, thanks, Matt. So let's talk about that 20,000 we talked about, taking the money out. There's a lot of different options for it, Bill.
Yeah, I mean, spend it. Maybe one year you want to take the whole family to Hawaii, and so use that 20,000 to do that. How about gifting? You know, you can gift to family to some pretty big numbers to keep it below the gift tax exclusion. You could gift it to a charity, you know, have to your endowment, to your hospital. You can convert it. You know, the illustration that Matt just went over talked about converting that to a Roth to make it tax efficient. You could just put it in a non-qualified investment bucket and earn the interest and dividends and capital gains from there that are going to be taxed at a lower rate. That's really the lowest rate you can pay in taxes are capital gains rates. And then you may want to do a wealth replacement strategy. So that would involve potentially getting life insurance, permanent life insurance, that you could fund with that money since you don't need it, and at your passing would go to your beneficiaries tax-free to replace that wealth that would be lost when they start to take their required minimum distributions over that 10-year time period.
So a lot of different options, and it really starts with, Matt, as we talked about, does it make sense? Does your tax strategy, income strategy make sense, taking money out, and then determine, okay, what should you do with it?
That's exactly right. And again, Eric, we just go back to you want to be in the driver's seat when it comes to taxes and where you're going to put your retirement assets and how you're going to begin to take them. And I know in shows prior, you've mentioned that most people fail in the retirement distribution phase. And that's really where we believe that we can be an asset and help a lot of people out.
And, you know, you may be in a situation currently where you've got, 10, 15, even 20 years to retirement, and you think that, I'm not going to have accumulated a large pot of money. But I think what's important to understand here is that we have shown that just with some current savings and a savings rate, again, that is not what we would call high savings rate. It's a good savings rate, but it's not, an assumption that we've put somebody in saving large numbers over time. You can accumulate assets. I know that all of us have worked with clients over the years, and in my 27 years of doing this, I've had many clients say, I just didn't realize that I would have accumulated that much. So Bill, Matt, thanks for today. If you are in this situation where you have questions on your retirement income strategy or your retirement savings strategy and you want help, we are here. This is what we do with clients each and every day, is we help them put together a plan for themselves to make sure it's right for you, not what's right for your neighbor. What may be your neighbor or your friend's decision and financial well-being may not be right for you. And what you want to do is make sure you take advantage of those really low tax rates that we have today. So I hope you enjoyed the case today. And for Matt Aurenz and Bill Davis, we'll see you next time right here on Your Wealth Health.